Hi, I am Dr. Clarence R. Pearson, Sr., and welcome to My View, a podcast where I offer my professional perspective on today's most pressing geopolitical and socioeconomic issues. Recently, my attention has been drawn to developments in Liberia, where the government of Liberia is set to roll out its new tax system, the Value Added Tax VAT. Here is my view on the matter. Value Added Tax VAT and what Liberians should expect, reform, risk, and the price of trust. Liberia is preparing for one of the most consequential tax changes in its modern economic history. Beginning January 1st, 2027, the country is expected to replace its goods and services tax with a value added tax, widely reported at a standard rate of 18%. The Liberia Revenue Authority has already confirmed the basic transition timetable. VAT registration opens from July 1st to December 31st, 2026, and implementation begins January 1st, 2027. The government's argument is straightforward. Liberia needs a more modern, transparent, and productive tax system. GST, as currently structured, is a blunt instrument. Businesses generally cannot recover the tax they pay on inputs, which creates tax cascading, a hidden tax on tax effect that raises prices along the supply chain. VAT, by contrast, allows registered businesses to claim input credits, making the system more efficient in theory. But the public anxiety is also justified. Liberia's general GST rate was 10% in 2023, rose to 12% in 2025, and has now moved to 13% for services, while telecommunications remain taxed at 15%. The planned 18% VAT therefore represents a sharp increase in the visible tax burden, especially in a country where incomes are low, unemployment and informality remain high, and household spending is already under pressure. The question then is not whether VAT is technically superior to GST. It often is. The real question is whether Liberia's institutions are strong enough to implement VAT without turning a reform into another burden on the poor. Why government wants VAT? The case for VAT begins with Liberia's fiscal reality. The government needs more domestic revenue to fund roads, schools, healthcare, debt service, and the arrest agenda. International lenders, including the IMF, have consistently encouraged tax reforms that broaden the revenue base and reduce dependence on external borrowing. The IMF's recent Liberia program emphasizes fiscal discipline, domestic revenue mobilization, and better public financial management. VAT is attractive because it is broad based. It collects revenue at each stage of production and distribution, rather than only at the final point of sale. If properly administered, it reduces evasion, improves documentation, and forces businesses into a more transparent accounting culture. But VAT also tests public trust. Citizens are more likely to accept a higher consumption tax when they can see roads repaired, clinics stocked, schools functioning, and corruption punished. If VAT revenue disappears into travel budgets, political patronage, luxury vehicles, or opaque spending, the reform will be judged not as modernization, but extraction. Liberia's challenge is therefore moral as much as technical. VAT can help build the state, but only if the state proves it is collecting more in order to serve better. What VAT means for ordinary Liberians. For ordinary Liberians, VAT will be felt first in prices. Consumption taxes are usually regressive because poor households spend most of their income on daily survival. Wealthier households can save, invest, or delay purchases. Poor households cannot postpone food, transport, soap, school fees, or medicine. Government officials have indicated that essential goods and services, including basic food, health, education, and agriculture related items, are expected to receive exemptions or special treatment. That protection is important, but exemptions alone are not enough. Even when rice or medicine is exempt at the final sale, VAT paid on transport, fuel, storage, packaging, or imported inputs can still become embedded in prices. This is why public education matters. Citizens need to know what is taxable, what is exempt, who is required to register, and how to report abuse. Market women and petite traders should not be frightened into thinking every small seller must collect VAT. But they also need to understand that larger suppliers may pass costs down to them. The danger is not simply that VAT will raise prices. The danger is that confusion will allow businesses to overcharge, officials to mislead, and citizens to blame one another instead of demanding clarity from the state. The business test: refunds, compliance, and cash flow. For businesses, the promise of VAT is input tax credit. A registered business charges VAT on sales, deducts VAT paid on business inputs, and remits the difference to government. This is the heart of the system, but the danger lies in refunds. In many developing economies, VAT refunds are delayed because governments are short of cash or tax agencies lack capacity. When refunds are not paid on time, businesses effectively lend money to the state without interest. That weakens working capital, raises operating costs, and often leads firms to increase prices. The LRA has begun staff training and public outreach, and Liberia's VAT system is being prepared through administrative reforms and registration planning. But implementation will require more than workshops. It will require reliable digital systems, enforceable refund timelines, transparent audit rules, and protection against harassment by tax officers. If refunds fail, VAT will lose credibility. If refunds work, VAT could become a turning point in Liberia's tax administration. The political risk of taxing without trust VAT is not just an economic reform, it is a political test. Liberians are being asked to pay more at a time when many already believe government wastes too much, explains too little, and delivers too slowly. That perception matters. A tax reform can be technically sound and still fail politically if citizens do not trust the people collecting it. The government should therefore treat VAT not as a revenue announcement, but as a national compact. Before January 2027, the administration should publish the full exemption list, clarify the registration threshold in Liberian terms, explain refund procedures, fund nationwide civic education, and commit publicly to tracking VAT revenue against visible social spending. The president and legislature should also consider a VAT accountability report every quarter: how much was collected, where it was spent, what services improved, and what refunds were paid. Without that, VAT will be seen as another burden imposed from above. Liberia does need a stronger tax system, but it also needs a stronger accountability system. The country's problem has never been only that government collects too little. It is also that citizens too often see too little from what government collects. The success of VAT will depend on whether Liberians experience it as reform or as another tax on hardship. My View is a continuing series where I share informed commentary on a wide range of geopolitical and socioeconomic topics. If you found today's discussion helpful, please follow, subscribe, like, and share. Thank you for spending this time with me, and I invite you to explore other My View episodes available online. Until we meet again, goodbye.